Hello, everyone, and welcome to AWCI's webinar, Succession Planning Without Regret, ESOPs versus Other Forms of Sale. My name is Tao Nguyen, AWCI's Education Program Manager. Before we start, a few housekeeping items. All attendees should be on mute during today's presentation. If you have a question at any time, please submit it using the question box in your GoToWebinar dashboard. We'll have a short Q&A session at the end of the presentation. The slide deck is available in the Handouts tab for download, and a recording of this presentation will be sent out later in the week. At this time, I'd like to welcome Stephen Arnold and Tyler Maines, Managing Directors from Lazier. Stephen Arnold is located in Columbus headquarters, and his market focuses on Ohio with an emphasis on Central and Southern Ohio. And Tyler Maines provides strategic advice to clients to help them achieve their personal, professional, and philanthropic goals. So at this time, I'll hand it off to Stephen and Tyler to share with you more about their background. So welcome, Stephen and Tyler.
Thank you, Tal. Thank you, Anne-Marie, for having us. Hi to everybody out there. Thank you for joining us. We're going to lead a discussion today. We'd love it to be interactive with your questions, and anything that we don't touch on question-wise during the presentation, we will certainly leave time at the end to answer your questions, whether they're very specific or very high level. We understand that the people on this presentation may have a varying degree of understanding of ESOPs versus third-party sales versus other management buyouts, and so we're going to try to stay fairly high level, but also giving you a little bit of meat and details. And we're thrilled to be here with you, and we'll get started. So we've titled this Succession Planning Without Regret, and let's talk a little bit about Lazier Capital. So Lazier Capital is our firm, founded in 1999. We are headquartered here in Columbus, Ohio. We have a range of services, but we do sell-side engagements and ESOP advisory. So we will do third-party M&A. That was the origin of our firm. And then over the last 10, 12 years, it's become very ESOP-centric. So we still do both ESOP sell-side ESOPs. That's about 90% of the work we do. But we also do third-party sales, and that was the origin of the firm. So we've led hundreds of transactions, billions of aggregate market value, and our focus here at Lazier is entrepreneur-owned mid-market companies. So we're helping with sales in the 25 million to a couple of billion range. What started as 3 owners and employees here in Columbus has grown to about 45 employees. We now have a business development team that spans the entire country, from California to Texas to Michigan to Ohio, all the way out to New York City and down to Atlanta and Charlotte. We're in 11 cities and 9 states, but we cover the entire country. And we've divided into an execution team, which is our accountants, CPAs, tax folks who help work on the deals and in the numbers. And then we have a business development team, and we work hand in hand with our clients.
So I'll pick it up from here, Stephen. I think just to give you guys a sense of who we are, why we're on here today. We are very much centered in the construction industry. I help lead our execution practice on the construction side. You can see sort of the differing industry associations we either participate in or members of. About a third to almost a half of our practice on any given year deals with companies in the construction or adjacent industries. So we're really well versed in the construction world, especially in the ESOP space, and so we're looking forward to kind of showing you, some of the unique features to that today. So really quickly, just to give you a sense of some of the representative transactions we've done over the years in the construction world. You may see a few of these that are relevant. We certainly do a lot of the building finishing contractors, specialty trade contractors, GCs, heavy highway, everything in between. So we really span the entire construction industry and look forward to giving you some of our thoughts today.
So one of the things important as business owners to think about defining your goals. If and when you have a succession plan, and every business eventually has one, what would be important to you? So here are some bullet points that we hear from business owners about what's important to them. So take a look at these for a minute. Instead of talking through every single one, take a look and see what might resonate with you. Obviously on the personal goal side, we hear a lot about maintaining control for a while and not having an immediate exit. we'll hear a lot about doing something for the employees, preserving the culture of the company. Sometimes it's protecting the community if the company's in a smaller town. But I think it's important to think about and your personal goals and matching that with the type of transaction that would best reach those goals. Same with the financial side, sort of a no-brainer that folks want to receive full value for the business. But a lot of times we're going to hear that, most of my wealth is tied up in the business. And I think it's time to take some chips off the table and diversify my wealth. Minimizing taxes is a big part of the conversation. We'll explain a little bit later how that's a part of the conversation that would bend towards ESOP and away from traditional third-party sales. Retaining a second bite of the apple, that kind of goes with, would it be important to maintain control of the company as you phase out versus having somebody else run the company and having less responsibility?
So I think we want to start the discussion a little bit on the succession planning side, really diving into just the different types of transactions that are out there and available in the market. So I think, we'll go through the 4 of these here, starting with a third-party sale to a strategic buyer. Generally, what you're looking at here is selling to a large competitor, a private entity or a public entity that's a large industry player. What you're looking at here is really someone who's in your industry that is a natural buyer here. And so what that generally means from a sale to a strategic is, typically a little bit more cash at closing, the ability to think through that synergistic value, which is really, if for someone in the construction world, you can think of it as purchasing power on shingles and things of that nature, where if you put the 2 companies together, they have the ability to cut some costs, maybe drive some revenue growth. How do you participate in that value as a seller? That also comes along with integration into the new buyer. So, how you're going to fit your current company into that new parent company or larger player in the industry. How can that impact your legacy, your culture? How is that integration going to be? Is that going to be a smooth transition or not? And then in general, just the potential for contingent consideration without control. So to the extent that there are future EBITDA or profit targets out there that you're going to be needing to hit to get your full purchase price, giving consideration to, are you still going to be at the helm? Are you going to be behind the wheel of the ship here to drive that future performance? Very similar third-party sale, but in this case to a financial buyer. Typically what you're looking at here is, private equity firm would be a great example of that. Again, more cash at closing, just given the structure. You can hear about the positives and negatives on a financial buyer perspective, just understanding what their future goals are for the company. So legacy, culture, continuity of operations, your management team, how the impact of that transition is going to happen, and also what type of transaction the financial buyer is doing, whether that's a platform transaction and making you the new go-to entity that they plan to add on additional companies to in the future, or if you're joining a platform company and growing the organization in general. So again, contingent consideration, you can think about it if you've heard of an earnout or a clawback, some type of future target of profitability that you're going to need to hit. And then what typically comes alongside that financial buyer is going to also be the extent to roll over additional equity into the new company. So again, thinking through what that control mechanism looks like after you've essentially sold your stock to this new company and how you're going to be able to get to your full purchase price. Again, significant debt typically used in that transaction. So just understanding what the impact of the balance sheet and things of that nature look like in that type of a transaction structure. In ESOP, like we'll talk about in greater detail as we move forward, but in general, understanding in doing a transaction with an employee stock ownership plan, seller maintaining operational control, you're picking the time frame of when you're looking to exit the business. The buyer is a retirement plan instead of a different company or financial buyer. Typically less cash at closing. This is not going to be an all cash deal. There'll be a seller note perspective that'll be added onto that. But at the end of the day, Congress has made major tax benefits to sell to your employees through this retirement plan. So we'll talk a little bit about those as we move forward. A lot of our clients that choose the ESOP route discuss a lot about just preserving their legacy, the culture of the business, We like to say day one of the ESOP after you do the transaction should look the exact same as the day before you did the ESOP. So a lot of continuity in operations. But again, it's a leverage buyout. There will be a debt piece to this, so there'll be a debt burden. And as I mentioned before, because it's not an all cash deal, the seller is really going to be relying on the performance of the entity and profitability moving forward to get the full purchase price. Similarly, management buyout has a very similar take to the ESOP, really without all the tax benefits. So you're really looking at, management taking over that operational control from the seller. The pro of that obviously is the buyer is a trusted partner that you've typically performed well with over the long term. Again, less cash at closing. There are some tax inefficiencies with doing a management buyout, but at times it can be a great tool to the extent that management has the financial wherewithal to make this transaction happen. Again, similar preservation of legacy, culture, continuity of operations. And then again, at some point there will be a debt burden on the company just to finance that transaction.
Yeah, so kind of drilling down here on the two big ones, comparing an ESOP to a third-party sale. I think this slide will be really helpful as we talk through it. So first, when we look at the taxation of proceeds in a third-party sale, you're going to pay federal long-term capital gains tax and state long-term capital gains tax. So in Ohio, for example, you're going to pay 25 or 30% tax on the sale to a third party. If you live in California, you live in New York, you're going to pay much higher tax because of the state tax there. If you're in Texas or Florida, you're going to pay obviously far less. But there is a tax burden associated with sale to a third party and to a competitor, to a private equity firm. On the ESOP, you have a choice. You can pay the long-term capital gains tax, or you can elect to make it a tax-free sale. And some of you may have heard of qualified replacement property, section 1042 of the Internal Revenue Code. That's a section that's sort of a sibling to 1031. Most of you have probably heard of 1031, where real estate folks sell a piece of real estate and roll the proceeds and gains into a new piece of real estate to avoid tax. So 1042 is a way to avoid tax in the ESOP space. It's something that we talk about more specifically beyond, but for your purposes, what you need to know is ESOP gives you flexibility to decide to keep it simple and pay your long-term capital gains rates, or to elect to jump through a few hoops and save considerable amounts of money on tax by making it a tax deferred and ultimately tax-free sale. Liquidity and payout. In a third party, you're going to get an upfront sum, and that typical amount is going to be more than you're going to get upfront at close in an ESOP. And you're going to have usually an earnout or a rollover. The thing to remember here in a third-party sale and that earnout is you're no longer in charge of the company. In fact, your role is negotiated at close. Might be 6 months as a consultant or 2 years, but you're no longer in charge. So your earnout depends on the performance of the company while somebody else is in charge of it and running it, and you're sort of more of a passive bystander at that point. In an ESOP, you're going to get an upfront amount, usually about 30 to 50% upfront, plus a fixed amount, which is on a promissory note, which is a promise to pay from the company to you based on the performance of the company over that next 4 to 6 years. And so one of the things that ESOP sellers have to feel good about is the next 4 to 6 years of their company in terms of making money and driving cash flow. In terms of predictability, sales of third party are far less predictable than ESOP sales. I think depending on the statistics that you look at, third party sales fail, don't close at somewhere in the 40 to 65% range. So they're a little bit less predictable in terms of whether they're going to actually close and get you the money that was kind of promised up front. On the ESOPs are extremely predictable in terms of what you're going to get at close, what you're going to get in years 1, 2, 3, and 4, what your team is going to get in terms of the management incentive plan, and what your employees will get over time at different levels of earning in the company. So a high degree of predictability there. In terms of disruption to operations in a sale, you have more material disruptions in a third-party sale. The buyer would have access to your employees and your customers. I mean, let's be honest, if you're selling, your employees know, your customers know, your competitors know, everybody knows you're selling. In an ESOP, there's a specialized deal team, so there's more of a minimal disruption to operations. Normally the employees, nobody knows that you're considering an ESOP until you decided to do it. gone through the process, and then you announce it to the team with a communications package. So it's much more specialized and private, and minimizes the disruption to operations. In terms of employee impact, in a third party, the impact really varies. It could be really excellent for certain employees. Other employees, 20% of the company could get cut in a private equity situation. So it really is a little bit more unpredictable. Could be good for some, bad for others. Hard to know until you get into the actual close and seeing what happens in the first few months or years after close of a third party. In an ESOP, generally positive across the board. Employees are going to get an additional retirement package on the ESOP layered on top of the 401k they already have, and the employees do not have to contribute to the ESOP in order to get that benefit. In terms of likelihood of close, again, we talked about that a little bit, around 50% for third party. For an ESOP, close is close to 100% once you get there. Over the years, we've had a few owners get all the way to the 11th hour and decided they couldn't transition at all. Usually they're older owners, have been there forever, but there's a lot less uncertainty of close in an ESOP than there is in a traditional third-party sale. Probably the most important slide on this chart to the owners is post-close involvement. In a sale to a third party, that's negotiated during the sale process. You may have some involvement, little involvement, but you're definitely not alone in control of the company. In an ESOP, it's flexible. You're going to remain in operational control of the company through controlling the board, being on the board if you want. But you can choose whether you have the management team that's good enough now, you can go ahead and step away. Do you want to work 2-3 years, 5, 7 years? Do you want to work indefinitely? You just want to start to monetize this company while you're doing it. And so there's a lot of flexible. Flexible is a great word to describe the ESOP.
So a question that came up is, what's the typical duration from first contact to a deal closing?
Our firm uses a three meeting process. It's sort of a get together. What are your hopes and dreams? Let's hear about what's going well, what's not going well, what would be important to you in any succession plan. We tell you a little bit about the firm. We tell you a little bit about ESOPs and third-party sales, see where you're leaning, because we can do either. A lot of times owners want to decide they want to know more about the ESOP, or the introduction was based on learning more about the ESOP. So we'll do an ESOP 101 in the second meeting, which is about a 90-minute, charts and graphs. Here's how the ESOP works for the company, for the employees, for the management team. Here's what the owners would get. And then there's a feasibility analysis, which is meeting 3, where you, for about 30 days, our execution team works with the CFO, controller, owner to help them build their 5-year projections. And then we take those numbers and show exactly what the owner gets, what the employees get, management team. Some firms charge 20 to 50 grand for that. We actually waive the fee on that because we want folks to see it. And then if someone says we want to do the ESOP, and ESOP is typically 4 to 5 months, and so it does close quicker than a traditional third-party deal. So from start to finish, meet to end, 6 to 12 months is a typical ESOP process. So a couple of considerations here. So if you felt like the last chart was a little bit slanted towards ESOPs were positive, we just want to remind you as more positive. ESOPs are not a silver bullet. There's some considerations you have to take into consideration. In a third-party sale, you're going to get more cash up front at close, period. You're looking for a synergistic value in a third-party sale, maybe 1 + 1 = 3, because combining with another company gives you something you didn't already have and allows you to achieve more efficiencies or economies of scale. Third-party sale is also going to typically give you an earlier exit. If you're done and you want to go to Arizona and Florida, you want to be done tomorrow, and you don't have a great management team already in place that could take over day one, that's going to be a third-party sale. But you have to remember there's contingent consideration there, that you're no longer controlling the company, and a lot of your payout there on the third-party side is based on the performance of the company when you're now not running it. Or maybe there's rollover equity where you have to leave a piece of your stake in the company. You don't get paid out for that initially, and then over time, as the company turns over again, then you could be paid out. So there's give and pull there in terms of being able to leave earlier, but having contingent consideration. And you do have to hand over control and decision making. For some folks, that's easy. Other folks, it's very difficult to even conceptualize doing that. In the ESOP, 25 to 50% of what you get is upfront at close with no personal guarantee. So if the company fails 4 years later, you're not on the hook for the money that you received at close. The rest of the money to a seller goes on a seller note, and we're getting low to mid-teens interest rate. So you're getting rewarded for being a patient seller over that 4 to 6 years by getting a higher return on that money. So if you're willing to be a patient seller, the ESOP is a way to actually make more money than a traditional third-party sale in the construction and contracting space for the most part. But you must believe in future earnings. That doesn't mean you have to be on a straight upward trajectory. You can have blip years. People had COVID years, but you have to believe that your revenue and cash flow is going to be pretty solid moving forward, at least for the next half dozen years. And you have to have employees capable of running the company. It doesn't mean you have to have everybody in place. You have 3 to 5 years to add to the team. We have a management incentive plan that we add in that you can use to incentivize new executives to come bolster your team. But you do have to, in general, have employees capable of running the company. And typically in an ESOP, you're going to need 15 to 20 employees up to an unlimited amount, hundreds, thousands, but 15 to 20 would be on the minimal side. So looking through what is an ESOP, some of you might be like, wow, we've already jumped in here. Can we just start with what an ESOP is? Because most owners know more about the idea of selling to a competitor or selling to a private equity firm. So an ESOP at a high level is an employee retirement plan. It's an ownership transition tool, and it's essentially a tax-efficient leverage buyout. So as an employee retirement plan, an ESOP is a qualified retirement plan with some similarities to a 401k. So you're getting tax-deferred growth on those shares and money inside the ESOP plan. There is an ESOP trustee appointed. So there's an ESOP trust created, a paper creation of trust. There's a trustee appointed to kind of govern the trust. That's where the shares are held. And that trustee is usually an attorney, someone who's been around for a long time, fell in love with ESOPs. They have 50 or 100 ESOP clients. And so they're the plan fiduciary. They want to make sure that everything is fair for the employees who are not at the bargaining table. All right. The trustee has no interest in running the company, so it's business as usual. The employees vest in the ESOP over time, and it can be based on the amount of money they make or a formula that includes the amount of money they make and how long they've been at the company. Then the company buys out the employees at retirement. There's also provisions for death, disability, getting fired, leaving for a competitor. And one thing you want to remember about ESOPs is they were created in the 70s by Congress, promoted, codified for S Corps in the 90s, backed again by the Secure Act 1 and 2. This is the only thing that Democrats, Republicans, and independents agree on, literally the only thing in Congress. There's a lot of incentives there. They want you to do an ESOP, and they've created substantial tax advantages to incentivize. Remember, the ESOP trust becomes the single shareholder of the company. Who owns an ESOP? It's the ESOP trust. There's a single K1, and that's what leads to some of the tax advantages. Normally, you've got more of an ownership-minded culture in ESOP because you've got employee owners who are rowing the boat the same direction. You're maintaining operational control with a flexible phase out. And then it's a tax-efficient leverage buyout in that you can defer as a seller and ultimately eliminate capital gains if you choose to do so. And then one of the big boons of an ESOP is that your company can be exempt from federal and state income tax forever moving forward from the date of close. So we can get you to the right entity form. Next slide. So quickly, how does an ESOP compare to a 401k? In a 401k, the employee contributes money, their own money, to the plan, and the employer matches. In the ESOP, the employees contribute nothing. All shares are granted by the company, so no cost to the employee. In a 401k, the employee's retirement funds are invested in stocks, bonds, mutual fund, Vanguard, Tesla, whatever. In an ESOP, the primary asset held by the retirement plan is the stock in the company where they work. So that's considerably different than, and again, we're not replacing 401ks in ESOP. 9 times out of 10, we're just layering that extra benefit on top. In terms of employee ownership and enterprise strength, all the academics have looked at that. The National Center for Employee Ownership, Rutgers, has a white paper that typically the year an ESOP is adopted, a firm will experience a 4 to 5% productivity increase. So that's one reason that owners are bullish on doing ESOPs. ESOPs are also, as they've been studied, about half as likely as non-ESOP firms to disappear for any reason moving forward. One of those reasons is that ESOPs can be tax-free, and that helps their viability and sustainability. And ESOPs have been shown to be four times more effective in attracting and retaining key employees. So if you think about construction and contracting, or any industry, most owners are thinking about, how do I keep my good people? How do I recruit better people? And how do I build and promote productivity and efficiency? And then ESOP companies, folks stay longer, even the younger generation. They have higher wages and they have more than twice as much in retirement plans. So just to look at how ESOPs and the data and all the studies show there's a relationship there with enterprise strength.
Okay. So diving just a little bit deeper into the tax benefits that are unique on the ESOP side, as Stephen mentioned, tax-free sale, Internal Revenue Code 1042, again, the cousin of 1031. So it's really the same concept. Shareholder sells their shares to an ESOP, they elect to defer and then hopefully ultimately eliminate the income taxes on the sale by structuring it correctly. So really huge. This allows for a lot of times when you're taking a look at after-tax dollars in a third-party sale versus an ESOP, a lot of times the ESOP is going to generate more after-tax dollars, which is really what we try to get our selling shareholders to really key in on. The pre-tax number may be very high and it looks great, but after you do the waterfall of all the taxes, your after-tax number gets eaten up quite a bit. So as Stephen mentioned again, most state income taxes go away, federally tax-free from an entity perspective. Really what this magic does is it allows for the repayment of the seller to happen at an accelerated rate. And so, getting that first 25 to 50% up front and then having, no tax drag after the closing allows for not only the repayment of the seller quickly, but also just really driving the value to the employees long term. There's also additional income tax deductions that are available to sellers really by making a pre-closing ESOP contribution deduction that allocates additional shares to employees sooner. And that is really a non-cash deduction that's not available anywhere else. So it's really a nice value tax arbitrage there. And then from a estate planning perspective, there's a lot of things that are available in an ESOP transaction to really drive estate planning. So we like to mirror up both the corporate balance sheet and the personal balance sheet, make sure that we're taking advantage of all the estate tax planning that we can. These stock options or warrants that we talk about throughout here are really a powerful tool from an estate planning perspective. To really get that out of a selling shareholder's estate while they're worth very little. And then, as they certainly grow significantly in value, all of that happens outside of the estate.
So let's take a look at what your team's benefit, meaning your employees and your management team, would get through an ESOP. So some of the construction market labor challenges we've talked about: retention and recruitment of employees, job security. Owners want to provide, you want to provide a competitive benefit package. You want to have a meaningful retirement. You want to make sure your company continues to have a culture and sense of belonging and increase productivity. But we also want to have management incentives, because it's the management team that's going to drive the future value of the company. We want them to know that this company is home. We want them to stay, so we can provide them a significant, how do we provide them a significant economic benefit? And if in providing these incentives, do we want them to have to make a personal investment themselves, or we want to provide this incentive and this investment for them? And then there's risk and liability, and do we want personal guarantees when it comes to key management and buying in? So from a senior management incentive standpoint, all great succession plans have a way of incentivizing management to be as excited about the future of the company as the owners and the owners and sellers are. So in an ESOP, we're going to use stock appreciation rights to accomplish that goal. It's a bonus plan issued to, could be 2 or 3, up to dozens of senior management members. These are performance SARs that are about 10% of the company's equity overall. That does not dilute the value to the owner, and they're issued over a 5-year period. Payment of these incentives to the management team in an ESOP does not occur until the seller note has been paid in full. So the management team can earn these awards based on productivity, but they're not going to be paid out until the the sellers are fully paid out. So in year one, if the management team, year one post ESOP, if the management team beats the EBITDA goal, the profit goal by 1% typically, then that is they earn that. It would be paid out in year 6. as long as the seller note has been paid off by year 6. In year 2, management team hits year 2, beats by 1%, the EBITDA goal paid out in year 7. If they don't hit in year 3, then year 3 would not be paid out in year 8, and so on and so forth. And so that's how we provide. And then senior management incentive plan, the SARS plan, is not a qualified retirement plan. This is non-qualified money. So we like to joke that the ESOP shares are our get rich over a long period of time. We're adding a retirement benefit. The senior management incentives for those important employees, this is more the might buy a boat money. These are numbers that pop quickly over the 5 to 10 years when the company does extremely well post close.
And I think the big picture on that, if you think about, the benefits that are had here, you've got the employee stock ownership plan, the retirement benefit going to employees. That's going to be, what's going to happen to every employee. These stock appreciation rights get key management aligned with the selling shareholder to drive performance so that when the business does well, the ESOP does well, the senior management team does well, and the warrant holder, the sellers, do well because they're not only getting paid off in a quicker manner, but also receiving that upside, that second bite of the apple on these warrants or stock options that are out there.
So let's look at a sample ESOP design, how it would impact the everyday employee. So from a vesting standpoint, the most common vest is to see a 6-year vest from close. So after 1 year, the employees would be 0% invested or vested, and then it would be 20, 40, 60, 80, and 100%, making the employees fully vested at 6 years. So if they left after 5 years, an employee who was there from day 1 that the ESOP was created and closed, they would only take 80. They would only take 80% of what they had accrued. So after 6 years, they would take 100%. The other way to do this is to have a 3-year cliff vest, which means that at the end of 3 years post close of the ESOP, all employees are 100% vested. And then employees who come into the company would then have a 3-year cliff vest or the 6-year vesting schedule. So we're spreading out these obligations to the company to pay out over a long period of time, so we don't stress the cash flow of the company. And that's another reason that being tax-free as a company post-close is an enormous benefit for those firms. From an allocation of shares standpoint, we talked about this. It's going to be vested on an annual basis to employees. These shares are going to be allocated over an extremely long period of time. Employees are essentially taking turns getting paid out as they leave the company for one reason or another. Employee accounts. Employees are going to be awarded shares based on the percentage of their total compensation. If you make $100,000 and you're a worker at a construction firm and I make $50,000 at that same firm, you are typically going to get twice as many ESOP shares a year as I get. But remember, if you want to, you can create a point system using the amount of compensation, but also years of service, which can be in play when you have employees who are older, who have been there a long time, who may not be management, but you want to make sure they're properly rewarded and they're not going to be here 10 more years. So using a years of service component is a way you could solve for that. Repurchase obligations is the company's obligation to pay out the employees when they leave. In the event of a death, a disability, or retirement, the company has 5 years to pay that money out to the employee. Again, don't want to stress the cash flows of the company, but want to get folks paid out. You can pay sooner, but you have up to 5 years. And there are fairness considerations like the 401k plan, so you have to treat people the same way. And other terminations, like somebody leaves the company or is fired, the company can wait 5 years and then pay out over an additional 5 years. And then the valuation, you don't have to share as owners the value of your company with your employees when you do an ESOP. Each year in the ESOP, they get a statement that shows the value, the stock price, and the number of shares that they have in their account. So they can do the math there for their own account. We've had a few firms that were very transparent, wanted everybody to know the value of the company, but most firms keep that information with the management team and the board.
So the management or the vesting is not just for the management members, right? It could be also for office staff or anyone who works for the company.
The vesting schedule is for all the employees of the company. And Tyler, we'll talk a little bit about this in a minute. If you have a union component to your company, then we've done ESOPs with full union participation. And again, Tyler will talk about that. You can do participation from certain levels of the union up. And so, but it is all employees. So let's say it's a non-union shop. It's all employees from the person that's the administrative assistant at the front desk to the president, to the president of the company.
So just talking a little bit about, what an investment bank's role is in any transaction, but specifically on the ESOP perspective. So, we like to talk a little bit about, who is on the sell side, who's representing the selling shareholder, the key employees of the company. And so typically we are working hand in hand with both the selling shareholder and, the key management team members to craft this plan alongside company counsel, your accounting firm, your wealth advisors. Like we mentioned before, we love the fact that, we try to marry up the corporate balance sheet to the personal balance sheet, make sure that we are taking advantage of everything from a planning perspective to make this the most efficient transaction possible, and using a third-party administrator, much like what you would see in a 401k, but stepping that up a little bit from an ESOP perspective to help us craft the plan in a way that really meets all the goals of the key stakeholders. On the buy side, just hitting this a little bit more, the trustee team, as Stephen mentioned previously, the ESOP trustee is an independent fiduciary that has fiduciary obligations to represent the employees in this transaction and ongoing. So what that means is, while yes, they're a very passive shareholder, they want to be a knowledgeable shareholder. They're going to negotiate a fair market transaction like any prudent buyer would. They're going to be represented by their own counsel and then a valuation firm that will be coming up with a valuation range on their opinion of what the value of the company is. And so, our role really in that is making sure that we start from the beginning with goal identification. Like we talked about, our first conversation with clients is typically, more of a goals-based conversation. We really don't get into the nuts and bolts of the actual company, what the transaction looks like. We want to be able to craft a plan that meets the objectives for everyone. From there, it's really about advocating for value for our selling shareholders. And then obviously leading the tax and financial structuring, raising the debt, negotiating all the deal items, and managing the deal process. And with that comes a lot of reach out and negotiation with potential lenders, driving the cash at close to our selling shareholders. So we run a full bank process, a market bank process, and then they will obviously be represented by counsel as well. On the third-party M&A side, very similar makeup. An ESOP is really an M&A transaction with a retirement plan bolted onto it. They are obviously a little bit different processes in that, we've identified the selected buyer through a process in an ESOP scenario, where in a third-party M&A transaction, we're going out and actually identifying who those buyers are and engaging with them. So really a lot of what is done is very similar, other than that identification and negotiation with potential buyers. There's going to be the same creation of, marketing materials on the business, working with the selling shareholder and company management to tell the story of the business in the best light, moving through hurdles that come up during the transaction. There's never the same transaction twice. And so there's always something that pops up that, we have to navigate through. And then really making sure that the seller has a representative that has their best interest in mind throughout the entire transaction. Legal team, very similar, is going to be managing that legal diligence process, on the buy side, requests, flow of information, negotiating the purchase agreements, very similar in both ESOP and third-party transactions. And then from a financial advisor perspective, making sure that, optimizing a tax strategy, I think, is important in any transaction. Obviously on the ESOP side, it's very tax heavy from a structuring perspective. In a third-party transaction, there's going to be a lot more in terms of how we're setting up and structuring the transaction to optimize that tax strategy for our selling shareholder. And then, as we mentioned before, mirroring up the corporate and the personal balance sheet, making sure we're interacting with the wealth advisor to make sure that they have a plan for you financially long-term with the proceeds from the actual sale. So just to hit a little bit on valuation, I think, to the extent you've had a valuation done on your company in the past, this should look fairly similar, but we want to make sure we hit on these. But in general, from a construction perspective, our clients are typically looking at their businesses being valued based on these three methodologies out there. So the discounted cash flow method, or some sort of income approach that it relates to your future cash flows of the business. or most of the time that looks like a financial projection for the next 5 years, which I'm sure many of you are saying, I don't have a crystal ball of what's going to happen in the next 12 months. We work with you a lot to help craft those projections so that they're supportable. They tell the story of the business of where you're going, where you've been in the past, why things look different than they did, for the last 5 years than they will for the next 5 years. And really telling that story and de-risking those cash flows is really key from a valuation perspective. What will happen, from a market perspective is just going out and looking at what similar companies to yours trade at in the market. So that can either be looking to the public markets, what we've listed here. Obviously, I'm sure some of you, recognize the names here in the specialty trade contractor vertical. A lot of times they're not directly comparable, right? A multinational contractor, may not be a great comp for your privately held business, but there's some good reasonableness checks and benchmarking that can be done in that. And what we lean on a little bit more heavy is what we call, the transaction method. We're going to go out and look at the actual sale prices of similar companies to yours in the market. And so, we've put a few, examples of databases that we subscribe to where we're able to go in and actually look at actual transactions that occurred. What we've got here is really more specialty trade and building finishing contractors. So hopefully, in the similar vertical to where you all sit, and just what they're trading at today based on EBITDA multiples. So, this is really, a multiple is just an expression of value. So I don't like to use a multiple as the end all be all, but it's a good, reference point for what theoretically could be out there in sale.
So in the, just want to show you a slide of how selling shareholders get their money in an ESOP. So at close, you get that, 30-ish%. It can be a little less or all the way up to closer to 50, depending on the terms of the deal. In this particular one, looks like it's about 25-30% cash at close, no personal guarantee. And then in year one, on top of the cash you got at close, we're going to add principal from the seller note, which is the darker green, and then the lighter green. That's going to be some of the interest on the seller note that you're going to get as cash pay. Year two, we have more principal, more interest on that seller note. Year three, year four, and you can see what happens in a typical ESOP is that let's say you sold your company for $50 million. That was the enterprise value, the transaction value. Well, because you're being a patient seller and you're getting you're compensated like a mezzanine investor at some mid-teen level on the interest rate, you will typically hit that purchase price of $50 million by year four. And then we still have the warrants on the back end, which is 10 to 15% of the company. There's a date set at close to value the company once the seller note is paid off. And so think of it as an interest replacement warrant is basically a stock option. And so if the company has done the cash flows that you've expected when you get to that warrant date, then the payout will be exactly what you expect in a second bite. If your cash flows have been a little stronger than you anticipated, you don't get more shares, but those shares and warrants are worth more than you expected. If the company cash flow hasn't been quite as strong, you're going to get a little bit less money in that second bite. But the warrants are a way to participate in the upside of the company while you're monetizing it. So people might say, well, what if I did an ESOP now, my company does better in 3 or 4 years, maybe I'm leaving money on the table. Well, the warrant is one way that ESOP owners are able to participate in the upside of their company. So the lesson here is in construction and contracting, you can actually make more money in an ESOP than a traditional sale typically.
So just hitting a little bit on some of the specific considerations that we typically run across when we're doing a transaction. And this can be both on the ESOP side primarily, mainly because our selling shareholders are going to continue to be operating company post-closing, but also very much considerations on a third-party sale as well. So really, I think it's making sure that you're surrounding yourself with advisors that are well-versed in the construction world as you're going through any transaction is key. Maintaining those very important relationships with the bank and the surety, especially if you're a highly bonded contractor out there, making sure that you're giving both of those parties a seat at the table throughout the process and making sure that they have an open line of communication that allows them to put forth their needs and wants in this transaction. And then maintaining your current bonding program, making sure that you're going to have the adequate bonding capacity in the future to hit those projected numbers that you're going to need to hit to get paid out in full. So it's really making sure that we dig into, what your backlog looks like, bonded versus unbonded, the timing of those, your current working capital levels, your future working capital levels, and making sure that we have a great grasp of what that looks like long term. And then really around, as I'm sure you all, see from a perspective of with the bank and the surety, is just managing expectations on personal and corporate guarantees. Having someone, working on your behalf to negotiate those in the best light possible. And then as Stephen mentioned before, we just wanted to hit quickly on, union workforce consideration. As we hear out in the industry, there's a lot of misconceptions around, if you have a union workforce, it's a lot harder to do an ESOP. I would tell you that's not the case. I think we spend a lot of time understanding the union representation inside the company, analyzing what your payroll looks like on a union versus non-union basis, what those benefits are, what folks are inside the company that you'd like to maintain as a participant in the ESOP, and whether you want to have full union participation or semi or none. And really, I think that's just understanding everything that comes along with it. And that can be the CBA, understanding your relationship with the union, analyzing any sort of pension plans that are, multi-employer pension liabilities that are out there. Typically, those are looked at more favorably on an ESOP perspective because you have ongoing continuity of operations. In a third-party sale, those pension liabilities, that underfunded withdrawal liability on the pension side can be substantial and really have a significant impact on the valuation of your company when you choose to exit. And then just quickly, we want to give you a little, heat map, I guess, on, just construction world and ESOPs in general. Like I mentioned, about a third to half of our practices in the construction world on a given year. This is a couple years old, just given on the delay on the 5500. So I can tell you this has significantly gone up. Construction companies are looking at ESOPs as a succession plan and a transition strategy more and more. But in general, you can see, they're coast to coast, top to bottom. This is a great, exit strategy for a lot of folks in the construction world.
So I'm just going to leave this up here for folks to look at. These are some of the advantages we talked about. We also talked about some of the limitations. If we have any questions that folks want to put in now, we want to leave time to answer those questions. But if as we're kind of waiting to see if there are questions that come in, if we just pull this up at a really high level, a third-party sale is going to give you more cash at close. You're going to be able to walk away sooner typically, but you're not going to have control of the culture. You're not going to have control of decision-making, and some of your payout, sometimes a sizable amount of your payout, is going to be dependent on how the company performs without you running it. And the impact on your employees is going to be, could be good, could be bad, could be varied. The ESOP is a way you can monetize the company while values are high, still maintain operational control, and then fully exit on your time frame, whether that's 2 years, 5 years, 10 years, etc. People like to know, what about if I want my kids or grandkids to be able to run the company? If you're insistent on kids and grandkids owning the company, that ESOP won't work. But if you're okay with your kids running the company as C-suite or and eventually maybe being on the board, and while they're running it, having some board oversight on their running it, but they can be compensated like owners through the SARS plan, then ESOP is a wonderful function. So the kids and grandkids can absolutely be involved. And then on the management buyout side, we like to joke that management buyouts are usually really good for the employees buying the company, because usually they're getting a little bit of a discount. It's worth more. It is a way to maintain continuity, no question. A lot of times employees struggle with the personal guarantee or getting financing. It takes longer to pay the owner out, and the company doesn't have the advantages of being tax-free at close. So at a high level, that's kind of what we're looking at. Now, I said something that may have caught your attention earlier. That is that 90% of the work we do now is ESOPs, or are we just an ESOP firm just mentioning third party? The biggest deal we did in the past 12 months was a third party sale of a contractor in Pennsylvania. And so what we find is when we go and talk to folks about both, owners already know a little bit about third-party sales, and the more they learn about ESOPs, the more they want to hear about ESOPs typically, because our experience is that owners don't know a lot about ESOPs. I didn't when I came into this world from the wealth arena and previously been an attorney. And so a lot of times the information owners have is somewhat negative on ESOP, some of it's incorrect. And so our job is to come in and not be salesy, but to actually just talk about pros and cons, typical ESOP owners and sellers versus typical third-party owners and sellers, and help you kind of figure that out. Any questions that have popped up?
So right now, is there an ESOP plan or any options for really small companies, let's say less than 15 employees?
Yeah,
I'll talk
I would
about the
say,
size. I'll talk about the size, and Kyler can talk about the employee number. So ESOPs can be done at the $1 million EBITDA or profit level, $1.5 million, 500,000. So we did around 32 ESOPs last year. And to put that into context, there's a firm in California that did low 20s, a firm in New York that did low 20s. Nobody else has passed the mid-teens. And what we're doing at this point is typically 3 million of EBITDA or profit and up. And the reason that we've kind of stuck on that number over time is that the numbers really pop for what the sellers get at 3 million, for what the employee balances look like over 2, 5, 10, 15 years, and what the management incentive plan drives. The numbers really hit at 3 million. That's kind of where we start. On the employee side, you want to tackle that, Tyler?
yeah, I think, we've certainly seen, we kind of use that 15 to 20 employee mark as a good candidate for an ESOP. That's certainly not to say that somebody with 10 to 15 employees could not do an ESOP. It's just this is an M&A transaction that's heavily documented. It's regulated by the Department of Labor. ERISA governs everything to do with these retirement plans. So it just can become cumbersome from a cost perspective, depending on, the value of the company versus how much it's going to cost to set up. Given the legal, accounting, financing fees, everything that comes into play. So generally can tell you, certainly I've seen significantly less than 20 employee ESOPs out there. So it certainly can be done, just generally becomes a little bit cost prohibitive.
Okay, so this
And the
next one, oh, sorry, Stephen.
The sellers do not pay the cost out of pocket of for the investment bank on the ESOP. It's wrapped up and included in the seller note, which has interest on it. So that's one of the popular misconceptions, that and the idea that kids couldn't be involved. Those are two of the popular misconceptions.
All right, so this is a multi-part question here. Are all employees in the company required to participate in an ESOP? And how long before a new employee would be eligible to participate? And can the company exempt certain positions?
Yeah, so I could tell you, I can tell you in a construction world, we do a lot on the communication side up front to educate employees on why this is a good thing for them. Again, if you think about it from a 401k perspective and trying to, do the side-by-side comparison, in a 401k, you may have a lot of folks that just don't participate because they need to put up their own money to get a match from a company perspective or participate in the 401k. In an ESOP, 100% of the contributions come from the company. So this is like getting a free 401k match. So, generally when you educate the employee on what this actually means to them, no one is ever going to turn this down. This is a cherry on top of their retirement benefits. It's at no cost to them. So I think from that perspective, it becomes more of a plan design piece. So when they can start to participate would generally be, that would be up to the company on how they design the entry into the plan. But generally, it's very similar to your 401k. Most folks say, hey, as long as you're working 1,000 hours and you're here at year end, you're going to get an allocation of shares. There may be a small waiting period, 6 months from start date to when you actually, start getting service credit in the actual plan. That varies from time to time, but I can tell you it's usually pretty quick. Folks want the employees to get involved in the ESOP sooner rather than later because of the productivity increases that they see. They know this is a good retention and recruitment tool. And so, making this hard for someone to obtain is not what the end goal is here. And then as far as exclusion of employees, at the end of the day, this is a qualified retirement plan. And so outside of union participation and having some ability to have some subjectivity of who and in terms of what levels of employees that you want to include or exclude, at the end of the day, this still needs to be a non-discriminatory retirement plan. And so in general, I would view it in the lens of everyone is going to be involved in your ESOP. And then there are certain provisions in there, whether it's a part-time employee that, is really only working 250 hours a year for you, that might not reach that threshold, but it's under the ERISA guidelines in terms of, inclusion or exclusion in the plan.
Okay.
I wanted to add one thing about this is that we haven't talked about the impact for small towns for ESOP. So I grew up in a town called Marietta, Ohio. It's about 20,000 people in Appalachia on the border of West Virginia. And if you sell your company in that area, you want to be able to go to church and the grocery store without getting dirty looks because people got fired. And so as powerful as ESOPs can be in big cities and big regional communities, they are even more impactful in these smaller towns and rural communities where it's very close knit and there's a high degree of connectivity between ownership and the employees and their lives and their social lives and seeing each other. The other thing that we mentioned is we assumed when we started talking about ESOPs, when we did some ESOPs at the beginning all these years ago, that it was the money. And what we consistently hear from owners is that they like this life of relevance where they can determine with their own flexibility when they want to exit the company. They can keep going to the trade shows, keep being, going to the club with folks, and they're still the person that runs the company or is in charge of the company. But there's this idea in our minds that we're going to work X number of years and then we're going to be done that day. And the ESOP allows you to get away from that, to determine what your own exit strategy is going to be, what that period of time may look like. There's a lot of flexibility there to allow people not to have such a dramatic change to their lives as selling shareholders.
Okay, so if you convert a company to an ESOP and plan on staying for the next 5 to 8 years after the conversion, if the note is paid off, how is the retirement of the previous owners handled?
Yeah, so really that's, most of our owners will have an employment agreement when they sell the company. And really what that's there for is to protect the selling shareholder or the owner, give them the right to work. I've never seen an actual owner be asked to leave. Again, like Stephen mentioned, there's going to be a little bit more formal corporate governance post-closing, but at the end of the day, you're going to be choosing your exit path. And so when you go into retirement, depending on what route you choose, whether you do that tax-free, tax deferral sale, or you just sell the company and pay your capital gains taxes, there are varying different benefits that are available to the selling shareholder. So to the extent that you don't do the 1042 election, a selling shareholder can be a participant in the ESOP just like any other employee. There's going to be a compensation plan, a bonus structure. Everything else is going to be very similar to what any other C-suite executive would be getting, post-closing.
So
Tyler,
go ahead.
I was just going to say, Tyler, do you have the thank you slide you can put up? And on the 1042 versus ESOP slide, we kind of divide that into two conversations. We divide that into, is an ESOP the right fit? And then once that determination is made, it's, do you want to keep it as simple a transaction as possible and just pay the capital gains tax? Or do you want to elect to jump through a few hoops to make it a tax-free sale? That's a big discussion, the 1042. And it can become a rabbit hole. So we really just talk high level about that at the beginning. And then once someone says, I think an ESOP's right for us, then we go into, okay, let's take that hat off, put a different hat on and say, do we want to make it a tax-free sale or keep it as simple as possible? So those are two separate conversations.
Okay, so I think there's one more question here is talking about previous owners. So how can the ESOP administrator control the former owner's post-close act in the best interest of the employees, like making sure personal expenses of the owners and everything is handled without company funds?
Yeah, I think that really, is one, we spend a lot of time creating expectations of, in a closely held business situation, a lot of things are done, with right pocket, left pocket, and we understand that, and there's nothing wrong with it. It's just understanding that you are going to be stepping up to a little bit more formal corporate governance. Things are going to be a little bit more, scrutinized from a transaction perspective, and post-closing. We make sure that we set those expectations that, personal expenses are now personal expenses. They're not necessarily being, run through the business or things of that nature. And so at the end of the day, the trustee has a fiduciary obligation to make sure that as a shareholder, they're doing the right thing. The board has oversight of the actual executive team and the management team of the company. And so there are checks and balances there to make sure that, what's being done is truly for the sole benefit of the employee stock ownership plan, the shareholder, while also maintaining, significant benefits that any other executive would receive. Any of those fringe benefits, allowances, things of that nature are all built into our actual structure.
Great. So that's all the time we have for questions. Do you have any last closing statements?
Yeah, thanks again, Tal and Anne-Marie. Thanks to everybody who joined us today. If anybody has follow-up questions, Tyler and I have our contact information there on the screen. You don't have to worry about finding who's the Lazier person, the closest radius to you. All of our deals are run out of the Columbus office, so just give us a call. We're happy to have a conversation, even if you're just starting to think about your succession plan, and then ultimately we assign if there's a bigger conversation to be had, we assign the appropriate business development and execution team. So thank you for your time, and feel free to reach out if anybody has questions. We'd be happy to talk to you.
Well, thank you, Stephen and Tyler, for the presentations. Very informative. Thank you to all our attendees. Again, Stephen and Tyler would love to hear from you if you have more questions or your questions didn't get answered thoroughly. See you next time on our next webinar. Thanks, everyone.